Here is something I want you to sit with for just a moment. You worked for 30, 40, maybe even 50 years. You paid into Social Security with every single paycheck, money taken out before you ever saw it, money you never got to choose whether to invest elsewhere or spend on something you needed. And then you retired, and those monthly Social Security payments finally started coming in. And now, the IRS wants a portion of that money back in taxes. I know that feels deeply unfair, and honestly, a lot of people agree with you. But here is the thing. The tax on Social Security benefits is real, it is legal, and in 2026, it is quietly affecting more retirees than ever before. The good news, and the reason this video exists, is that there are completely legal ways to reduce that tax, and in some cases, eliminate it entirely. And most retirees have no idea these strategies exist. My name is Finn, and this is Finn Retires, the channel that makes sure your retirement income stays as protected as it is legally supposed to be. If you are new here, please hit that subscribe button right now before we go any further. Every week on this channel, we go deep on the rules, the loopholes, and the overlooked strategies that keep more money in retirees' pockets. And today's topic is one of the most impactful ones we have covered. So subscribe, grab a notepad, and stay with me, because by the end of this video, you are going to understand your Social Security tax situation better than most people who have been retired for years. Let us start with the foundation, because I want to make sure we are all on the same page before we get into the strategies. The question of whether your Social Security benefits are taxable is not a yes or no answer. It depends entirely on a specific number that the IRS calculates for each taxpayer, a number called your combined income, or what some tax professionals call provisional income. Here is exactly how it is calculated. You take your adjusted gross income, that is your total income from pensions, IRA distributions, wages, dividends, capital gains, and everything else, and you add to that any tax-exempt interest you earned during the year. Then you add 50% of your total annual Social Security benefit. That final total is your combined income. And it is that number, not your benefit amount alone, that determines whether you owe federal taxes on your Social Security. Now let me give you the thresholds that matter, because these are the numbers every retiree in America should know by heart. If you are a single filer and your combined income is below $25,000, your Social Security benefits are not subject to federal income tax at all. Zero. If your combined income falls between $25,000 and $34,000, up to 50% of your benefits can become taxable. And if your combined income exceeds $34,000, up to 85% of your Social Security benefits can be included in your taxable income. For married couples filing jointly, the numbers shift slightly. The lower threshold is $32,000, and the upper threshold is $44,000. Below $32,000, no federal tax on Social Security. Between $32,000 and $44,000, up to 50% taxable. Above $44,000, up to 85% taxable. These are the thresholds that govern Social Security taxation in 2026. And I need to pause here and address a misconception that causes more confusion than almost anything else in this topic. When people hear the phrase 85% of your Social Security is taxable, they frequently interpret it as meaning the IRS takes 85% of their benefit in taxes. That is not what it means. 85% is a cap on the portion of your benefit that can be included in your taxable income. The actual tax you pay on that portion is determined by your regular income tax bracket, not a special Social Security tax rate. So, if 85% of your benefit is taxable and you are in the 12% federal tax bracket, you are paying 12% on that 85%, not 85% of your entire benefit going to the government. For most middle-income retirees, the real effective tax rate on Social Security income ends up being much more manageable than the headline numbers suggest. But it is still real money, and it is still worth reducing legally, which is exactly what the rest of this video is about. Before we get into the strategies, there is one more thing I want you to understand about why this issue is getting worse over time, and why it is affecting more retirees in 2026 than it did 5 or 10 years ago. The income thresholds I just described, $25,000 for singles, $32,000 for couples, have not changed since 1984. They were set by Congress over 40 years ago, and they have never been adjusted for inflation. Not once. Meanwhile, Social Security benefits themselves increase every year through cost of living adjustments. In 2026, that COLA increase was 2.8%. Every year that benefits go up, more retirees who were previously just under the threshold get pushed over it. And every year that other income sources, pensions, IRA distributions, investment returns, continue to provide retirement income, combined income climbs higher. The result is a system where the goalposts never move, but the players keep getting pushed past them. More retirees are paying taxes on Social Security in 2026 than ever before, not because Congress raised taxes, but because the thresholds have been frozen for 40 years while everything else went up. Now, let us talk about the legal strategies that can reduce or eliminate this tax. And I want to be very clear. Everything I am about to describe is completely legitimate, fully legal, and specifically recognized by the IRS and the tax code. These are not loopholes in the shady sense of the word. They are tools that Congress built into the tax system and that financial planners use every day for their clients. The fact that most retirees do not know about them is simply a gap in information, and that gap ends today. The first and most powerful strategy is the Roth IRA conversion. Here is why this matters so much for Social Security taxation specifically. When you withdraw money from a traditional IRA or a 401k, that withdrawal is considered ordinary income and adds directly to your adjusted gross income, which increases your combined income, which pushes more of your Social Security benefit into taxable territory. A Roth IRA works completely differently. When you withdraw money from a Roth IRA, that withdrawal does not count toward your adjusted gross income at all. It does not factor into the combined income calculation for Social Security taxation. It is as if the money is invisible to the IRS for this specific purpose. So here's the strategy. If you convert money from a traditional IRA to a Roth IRA before you start claiming Social Security, or during years when your income is lower, you pay the tax on that conversion at that time. But from that point forward, the money in your Roth grows tax-free, and when you withdraw it in retirement, it does not add to your combined income, does not push your Social Security into higher taxable territory, and does not affect the threshold calculation at all. For retirees who are not yet receiving Social Security and who have traditional IRA money, this strategy can be genuinely transformative, particularly if done gradually over several years to avoid a large one-time tax bill from converting too much in a single year. The second strategy is one that a surprising number of retirees over the age of 70 and a half qualify for but have never used, and it is called a Qualified Charitable Distribution, or QCD. Here is how it works. If you are age 70 and a half or older and you have a traditional IRA, you are allowed to donate up to $100,000 per year directly from your IRA to a qualifying charity, and that donation counts toward your required minimum distribution for the year without ever being included in your adjusted gross income. Let me say that again in plain English. Instead of taking your required minimum distribution as income, which would add to your combined income and potentially make more of your Social Security taxable, you donate that same money directly from your IRA to a charity you care about. You satisfy your required minimum distribution requirement. The money never appears in your income. Your combined income stays lower, and more of your Social Security potentially avoids taxation. For charitably inclined retirees, this is one of the most financially efficient strategies available anywhere in the tax code. The key requirement is that the donation must go directly from the IRA custodian to the charity. You cannot take the distribution yourself first and then write a check to the charity. The transfer must be direct, and the receiving organization must be a qualifying public charity. The third strategy is brand new in 2026, and it is one of the most significant changes for retirees in recent memory. The legislation known as the One Big Beautiful Bill Act, signed into law in 2025, created a new temporary senior bonus deduction for taxpayers aged 65 and older. In 2026, this deduction is $6,000 per qualifying individual, meaning a married couple where both spouses are 65 or older can deduct $12,000 from their taxable income on top of their existing standard deduction. This deduction is available through 2028. What makes this particularly powerful for Social Security taxation is its effect on the calculation chain. Lower taxable income means lower adjusted gross income, which means lower combined income, which means potentially staying below the thresholds that trigger Social Security taxation. For retirees whose combined income has been hovering just above the $25,000 or $32,000 thresholds, this new $6,000 deduction may push them back below the line entirely, meaning their Social Security benefits go from partially taxable to completely tax-free at the federal level. If you are 65 or older in 2026 and your tax preparer has not mentioned this new deduction to you, bring it up at your next meeting. It is new, it is significant, and not every preparer has it fully on their radar yet. The fourth strategy involves the timing and management of your other income sources, specifically your IRA distributions. Many retirees take their IRA distributions on autopilot, withdrawing the same amount year after year, or simply taking whatever their required minimum distribution requires. But the combined income formula means that strategic decisions about when and how much to withdraw from traditional retirement accounts can directly affect how much of your Social Security is taxable each year. If you have a year where your Social Security benefit is your primary income and your IRA distribution is modest, your combined income may stay below the taxable threshold. But if you take a large IRA distribution in that same year to pay for a car, a home repair, or a trip, that additional income can push you over the threshold and make a portion of your Social Security suddenly taxable. The strategy here is to think about income sources as a system rather than in isolation. Spreading large IRA withdrawals across multiple years rather than taking them all at once, timing major financial decisions around years when other income is lower, and working with a tax professional to project your combined income before the year ends, rather than discovering the consequences in April, are all practical ways to manage this. For retirees with both traditional IRA money and Roth money, drawing from the Roth in years when combined income is already high, and from the traditional IRA in years when combined income is lower, is a simple rotation strategy that can keep more Social Security benefits tax-free over time. The fifth thing I want to cover is not a strategy, it is a warning, and it catches retirees off guard more than almost any other part of this topic. Many retirees who are trying to manage their taxable income invest in municipal bonds, government bonds whose interest payments are exempt from federal income tax. The assumption is that tax-exempt interest is invisible to the IRS when calculating Social Security taxation. That assumption is wrong. The combined income formula specifically includes tax-exempt interest in the calculation. The IRS requires you to add your tax-exempt interest income to your combined income when determining whether your Social Security benefits are taxable. So, if you earn $5,000 in municipal bond interest during the year, that $5,000 counts toward your combined income threshold for Social Security taxation, even though you do not owe any direct income tax on the interest itself. This surprises a lot of people, and it means that a portfolio designed to minimize taxable income through municipal bonds may still be pushing Social Security benefits into taxable territory without the retiree realizing it. If you are using municipal bonds as part of your retirement income strategy, make sure your tax planner is accounting for this when projecting your Social Security tax situation. I also want to quickly address the state tax question because it comes up frequently. As of 2026, most states in the United States do not tax Social Security benefits at the state level at all. The majority of retirees only face the federal thresholds I have described. However, 9 states currently still tax Social Security benefits in some form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and Kansas, each with their own rules, income thresholds, and exemption structures. West Virginia, which used to be on this list, phased out its Social Security tax completely as of 2026. If you live in one of those 9 states, it is worth a separate conversation with a tax professional about your specific state's rules, because the state impact on top of the federal calculation can add up meaningfully depending on your income level. Now let me bring all of this together with a picture of someone who used these strategies well and what it meant for their retirement. Think about a couple named Richard and Barbara. Both are 67. Richard receives $2,200 per month in Social Security. Barbara receives $1,400 per month. Richard has a traditional IRA with a substantial balance that triggers required minimum distributions each year, and they have some municipal bond interest from a portfolio they built over the years. In a year where they took their full RMD from Richard's IRA without planning, their combined income pushed past $44,000, putting 85% of their Social Security benefits into taxable territory. The tax bill at the end of that year was a number they had not planned for. But the following year, they sat down with a tax advisor and made several changes. They had Richard's IRA custodian send his required minimum distribution amount directly to their church as a qualified charitable distribution, satisfying the RMD requirement without any of it appearing in their income. They shifted a portion of their municipal bond holdings to a tax-efficient index fund, whose dividends were managed more carefully. They claimed the new $6,000 senior bonus deduction for each of them, reducing their taxable income by $12,000. And they took a modest draw from a small Roth account Barbara had funded during her working years, which added to their spending money without affecting combined income at all. The result was a combined income that fell back below the $32,000 threshold, meaning zero federal income tax on their Social Security benefits that year. Not a reduction, zero. The strategies worked because they were applied as a system, each one building on the others. Here is what I want you to do with everything you have just learned. First, calculate your own combined income for this year. Add your adjusted gross income, your tax-exempt interest, and 50% of your expected annual Social Security benefit. Compare that total to your filing status threshold, $25,000 for single, $32,000 for married filing jointly. If you are above the threshold, figure out by how much. That number tells you the scale of the opportunity. Second, if you have a traditional IRA and you are charitably inclined, ask your IRA custodian about setting up a qualified charitable distribution before the end of this calendar year. Third, if you are 65 or older, make sure your tax preparer knows about the new $6,000 senior bonus deduction available through 2028 and is applying it to your return. Fourth, if you have traditional IRA money you have not yet converted, and you have years ahead before or early in retirement, consider whether a staged Roth conversion strategy makes sense for your situation. And fifth, review your investment portfolio with the combined income formula in mind. If you hold municipal bonds and your combined income is already near the threshold, those bonds may be contributing to your Social Security tax without you realizing it. If this video helped you see your Social Security situation from a different angle, or if it gave you a strategy you had not heard before, I want to ask you to share it with someone in your life who is retired or approaching retirement. The strategies in this video are available to everyone, but only if they know about them. A share from you today could save someone hundreds or even thousands of dollars in taxes this year. That is not a small thing. Drop a comment below and tell me, did you know that Social Security could be taxable before watching this video? And have you used any of these strategies yourself? I want to hear your experience. The conversation in the comments on this channel is always one of the most valuable parts. Real retirees, real situations, real outcomes. Share yours below. I read every comment personally, and your story might be exactly what helps someone else take action. The next video on this channel is going into the Social Security spousal benefit rules. Specifically, the strategies married couples are leaving on the table right now that could be worth hundreds of dollars more every single month. If you are not yet subscribed, hit that button now. You do not want to miss it. Take care of yourself, protect your retirement income, and I will see you in the next one.